Yeah. So yeah, in the trading journal, I actually put that you need to put the lot size that you use to get you into the habit of obviously using the correct lot size. And as your trading account grows, obviously your lot size is going to get bigger. Now, I just wanted to just explain what the risk management is and how to use the risk to reward tool, how to use the website, and how to get the most out of the risk to reward. So for anyone that doesn't know, the risk to reward tool is actually on the left hand side. It's this back panel here. Is it this panel here? No, it's this one down here. My bad. Yeah, the long position and the short position. So I've actually made these my favorites by just pressing those little stars, and then I've got it down here. So if we click the short is a sell, long is a buy. So if we click this short position and we put that here, by default, let's move it up here a little bit. By default, it says 1 there. So risk to reward ratio is 1. So that means that this is a 1-to-1 trade by default. You're risking 1% to make 1%. Yeah. So that's a 1-to-1 trade. So if you was to take a 1-to-1, you would need to obviously find out the lot size first, but that's what a 1-to-1 is. So if we drag this down and make that, let's open this up a little bit, make this a 2, that's a 2-to-1 trade now. You're risking 1% to make 2%. And then the only trades we need to go for, but it has to be a minimum of a 3-to-1 trade. Even in Mark Douglas Trading in the Zone, he says you should only take trades that are 3-to-1 or 1-to-3, doesn't matter what way you want to put it. So you only want to take trades that look like this. You're risking 1% to make 3%, right? Now, on the higher time frames, we go to the higher time frames, like the 4-hour, for example, and then we throw on this risk to reward ratio here. Let's pretend we want to go in for a buy here. Just come down a little bit. So a 3 is a 3-to-1. So that, on a 4-hour time frame, is the type of trades that you want to go for on the minimum, right? And that, pips wise, that was a massive move. That was like 300 pips, and your stop loss would have been, say, 100 pips, right? To catch a move like that on the big time frames is quite hard, because that's a lot of pips to catch, right? So what we've recently started to do, and what the Trade House tries to do as well, is to get those sniper entries on the lower time frames, like the 5-minute and the lower time frames, because when you do that, you literally can, instead of trying to catch a massive move to get your risk to reward ratio, if you can get a sniper entry on, say, the 5-minute time frame, and this is like kind of like recently what we've been going over with our trainings, this candle here, if we say once it's made its move and it's going to be on a downtrend, if we put our risk to reward ratio here, stop loss just above the highs, we say if this comes back up to test this candle here, we're going to go in for a sell. Risk to reward ratio is put on, and even targeting, say, this candle here, the risk to reward is, it's going to be like pretty much a 3-to-1. Let's just make it a 3-to-1. It's annoying that actually. Okay, so that says a 3 now. So this is a 3-to-1 trade. So I just showed you on a 4-hour time frame to catch 300 pips, risking 100 pips. That's a big move. But you can catch a move like this on the lower time frames. So this pip wise, catching pretty much 70 pips with, say, a 25 pip stop loss is more realistic, and you're gonna make 3% more likely this way than on the higher time frames. So to put that, let's do the maths on this, right? So this trade was Euro AUD. So this is actually how I have my layout for my trading. So I've got a different web browser open. So I've got my trading view, I've got my meditation music or whatever you want to have, like relaxing, chilled music. I've got my economic calendar, so I know the news events that are coming up. And then I've got my position size calculator. So with this particular trade, it's Euro AUD. Let's pretend we've got £300 in our account. We're risking 1% because it's a 1-to-3 trade. The stop loss, let's just say it's going to be 10 pips. The trade is Euro AUD. So let's find Euro AUD. You just press calculate. So that particular trade, it's saying for every 10 pips it moves, you're going to make 1% in your account and you're going to make £3, right? So that trade was a 1-to-3. So that one, you're going to make £9, right? But what is a good thing, a lot of people do not know this, this is a 1-to-3 trade, okay? 1-to-3. If you change this to 2, so you're risking 2% on your account, you actually double. So instead of it being a 1-to-3, because you've changed it to 2%, that's actually now a 2-to-6 trade. Okay, just by changing the maths on that, you're going to make a bigger return on the same trade. Yeah. So that is now although it says a 3, just because we've changed it to 2%, we're risking 2% of our account here. 2% we're risking to make 6% return down here. So therefore, because we've changed it to 2%, for every 10 pips, we are making 2% on our account, and we're making £6 every 10 pips. Yeah. So I hope that's starting to make sense to you guys. And this is why it's crazy if you can actually catch a big move on the lower time frames, which we are currently working on. So this move actually down here has gone all the way like down to here. So imagine catching something like this. This trade is a 7 to 3.2. So that's just, let's pretend it's a 1-to-7 trade, right? Risking 1% to make 7%. But if you are risking 2%, which typically most traders do anyway, you're risking 2% of your account here to make a 14% return in your account down here. So the math says that every 10 pips it goes, you're actually going to be making £6. And this as well, I forgot to mention, sorry, is the lot size down here. So if you did take this trade, the lot size, actually, no, I did update that. I'm looking at an old sheet. So the risk to reward ratio, and I did actually put in the lot size. So the risk to reward on this trade would be a 1 to 7 if you want to risk 1% of your account to make 7%. But if you use 2%, the risk to reward is a 2 to 14. So you have to put the risk to reward ratio in your journal, when you're journaling your trades. And then also you have to put in the lot size you used when you're journaling your trades. So this is telling you to use a 0.112 lot size. So you would obviously put that into your trading station, MetaTrader 4. That would be the correct lot size to use this is proper risk management. And then you obviously put in this lot size into your when you're journaling your trades. So this is why we're trying to catch moves like this, and we will be catching moves like this, because like I just showed you on the bigger time frames, to catch 300 pips is hard, and it doesn't happen often, and it can take a long time. But if you go down to the lower time frames like this, for example, and when there's a potential for a reversal, and you're getting in with a really, really tight stop loss, you are gonna grow your account fast. Not only that, when you're on the lower time frames and you've become a master at identifying these patterns, you'll be able to stack entries on the way down. So instead of just riding this one trade that you've got down, you can ride, they call it stacking entries. You can sell, for example, another sell opportunity on the way down, and then you've got a second trade on the go. So we just put this one here, stop loss there, and then we're riding a second trade down to make more money, right? I know this is a bit more advanced to stack entries. I do not recommend stacking entries for a new trader. Just want to focus on one trade, but I'm showing you this for the future when you get good at it, to make a bigger return on your account a lot quicker. We can stack entries on the way down when we're presented with the price action that's telling us to sell again, right? So this is powerful. It's proper risk management. It's taking the setups as they come, and you're not just stuck on the higher time frames. You've actually caught these moves on the lower time frames, and you're catching those sniper entries like Tradehouse likes to say. And this is why I wanted to stick with Tradehouse rather than the Steady. Like Steady, they do kind of a bit of Tradehouse, but some of their trades, they do use bigger stop losses because they're trying to catch like the next big swing. So they use like, say, 40, 50 pip stop loss, which means that if you've got a 40 or 50 pip stop loss, you're going to have to put a 50 pip stop loss in your position size calculator for the proper risk management. And then that means that every 50 pips it moves, you're going to be making £6. Yeah. And it's telling you your lot size to use at 0.02, because you've got a 50 pip stop loss. So this is why I really liked the sniper entries that Tradehouse is teaching, because if you can catch those kind of moves, you can get some insane returns for your account just because you've used the stop loss. Like, a lot of people don't really know this, but the stop loss isn't just your safety net to get you out the trade if it goes the wrong way. It's actually your profit regulator because it's showing you right here if you need to put in stop loss, because the stop loss calculates the correct risk management to use. And I did hear it from someone. It was someone from what Jenna heard. The smaller the stop, the fatter the lot. So that just means like the smaller the stop loss, the bigger the lot size. So the smaller the stop, the bigger the lot, or the fatter the lot, I think they said. So this is why I want to have us catching these moves on the lower time frames, and it is overwhelming. I'm not going to lie, because you think like when you're used to looking at a 4-hour chart, every candle represents 4 hours. Every candle here represents a whole day. This it's easy, but then when you start going down the time frames and you're like, right, okay, every candle represents an hour. And then to jump down to a 5-minute, it can get overwhelming. It does take a little while to get used to the patterns that it's doing on the lower time frames. But all I've done and all Ryan's done is you just got to watch the patterns that are forming on the lower time frames, and it takes time. You get there, but it is worth it, because you get these sniper entries, which means you have a better risk to reward ratio, which means you're going to make 10 times more money rather than trying to catch it on these bigger time frames. So does anyone have any questions at all on that? If not, then let me just see if I can show you another example. Actually, I'll stop this video for now.